Hello, everyone, and welcome back to the Deep Dive. I hope you are locked and loaded and ready for an exploration of one of the most critical industrial assets in the world. Today, we're doing a full, fundamental business quality analysis of Lockheed Martin, LMT.
The big one.
The big one, the unchallenged, preeminent defense contractor on the planet. And this is the company that builds the F-35. They are the backbone of Western security. It's foundational.
It really is.
And, when you look at LMT on the surface, it just seems like this untouchable, recession-proof fortress. It generates immense cash, it has a solid dividend, and its main customer is, well, the strongest sovereign entity in human history.
Right.
But in a landscape that's changing so fast with agile startups, new tech, and a volatile geopolitical environment, the central question for us as investors is this: does LMT's traditional hardware-heavy moat actually hold up? Or is the current valuation just, a bit inflated by all this global conflict anxiety?
That's the question.
We're going to break down the 4 critical pillars that define this entire investment case right now.
That is a massive, high-stakes question. And it really forces you to look past the headlines, right? Past the emotional reaction to conflict and just focus on the long-term business quality.
Exactly.
Is the fortress actually able to withstand a siege, whether that's an economic siege or, a technological one? But before we get into the F-35 and the balance sheet, just a quick note for everyone taking part in this deep dive.
Yeah, for those of you who want to act on these kinds of insights, you really need a world-class platform to do your own analysis. We use Interactive Brokers.
We do.
Their tools, their global reach, the pricing, it's all top tier. And we've actually partnered with them to get you, the viewer, a stock bonus when you sign up.
So you get a powerful platform to execute your strategy, and you're also supporting the channel's research at the same time. That link is ready for you right in the description below.
That's right. And of course, if you find real value in this kind of, detailed, no-fluff discussion, and it takes hours to put this together, the best way to let us know is to hit that subscribe button and like the video.
It genuinely fuels the channel.
It really does. And if you have any questions about LMT or ideas for the next company we should tackle, please manifest yourself in the comment section.
Perfect. With that out of the way, let's get down to the structural analysis. Pillar number 1, understanding the competitive fortress and the actual business model of Lockheed Martin.
Okay. Let's unpack this business.
Yeah.
To really define what Lockheed Martin does, you have to realize this is not, a traditional industrial company.
Not at all.
They function essentially as this highly specialized, absolutely critical engineering arm of the U.S. government. They're tasked with solving problems that are just. They're too classified, too dangerous, or frankly, too expensive for the private sector to handle without state backing.
They're the arsenal of democracy, as the saying goes. And that role definition is so important because it just fundamentally changes how you have to analyze the business.
It changes everything.
And, structurally, LMT has this inherent diversification across 4 powerful segments, even though the ultimate customer is overwhelmingly the Department of Defense.
So let's start with Aeronautics. This is the anchor, the biggest segment. It brings in roughly 40% of their total sales.
And this is just completely dominated by the F-35 Lightning II program. We're talking about the world's only integrated operational 5th-gen fighter system.
The only one. Then you have rotary and mission systems. This is everything from military helicopters like the Black Hawk to crucial cyber warfare capabilities and these massive ground-based radar systems.
The stuff that keeps the lights on, so to speak.
Yeah.
And then there's missiles and fire control. That's the segment that gets all the headlines when conflicts flare up, because that's where the high-precision kinetic weapons are. The system's designed to actually hit a target. So you're talking about the famous HIMARS rocket systems and the Javelin anti-tank missiles.
And finally, the space segment. This one kind of flies under the radar, no pun intended, but it's strategically vital. Satellites, strategic ballistic missiles, all the high-altitude assets.
Yeah. And what's so fascinating is this split between how simple the concept is versus how complex the operation is.
Explain that.
Well, the concept is simple, right? State-backed, high-end engineering to solve huge problems. But the operational complexity is what builds the fortress. You're dealing with decades of institutional knowledge, managing supply chains with over 100,000 suppliers.
Globally.
And executing on these multi-decade, multi-billion-dollar programs. So as long as you accept that geopolitical entropy, the natural tendency towards disorder is a constant, then LMT's role is enduring.
That complexity means the barrier to entry isn't just cash. It's decades of performance, trust, and the whole security clearance ecosystem. You can't just start this business in your garage, no matter how much VC money you raise.
No. And that endurance is baked into their contract mix, which really defines their risk. You can basically split them into two types. First, the standard method, cost plus contracts.
Right.
Here, LMT gets reimbursed for all their legitimate expenses, plus a guaranteed fee on top. So their profit is protected, even if the program goes over budget.
Which sounds amazing. But the flip side, where the real risk is, are the fixed price contracts.
Exactly. The government loves these because it shifts the risk. It offers LMT higher potential margins, but they agree on a set price up front.
Regardless of their costs.
Right. If they're efficient, great. But if inflation spikes or an engineering problem pops up, they are exposed to some potentially toxic losses. And that is a key risk we have to circle back to.
Absolutely. And that scale you mentioned, it leads directly to this economic concept called a monopsony, which is really the heart of their moat.
It's not a free market.
It's not a free market. You don't have 20 companies bidding. The Department of Defense is, for all intents and purposes, the single major buyer.
And that monopsony creates these monumental, almost insurmountable high switching costs. Once LMT wins what's called a program of record, a massive integrated system, it becomes functionally impossible to get rid of them.
So can you explain how that works in practice? It's not just about the money to switch, is it?
Oh, not at all. It's entirely operational. Think about it. You'd have to retrain entire air forces and navies.
Yeah.
Thousands of pilots, technicians.
And maintenance crews.
You'd have to rebuild and requalify these highly regulated global supply chains. And, crucially, you'd have to rewrite all the integrated software that links these platforms into the central command structure.
The cost of failure isn't just financial. It's a catastrophic loss of military readiness.
Precisely. And this is where the F-35 program becomes the ultimate, undeniable example of this moat. This isn't just a project. It's a projected $1.7 trillion lifecycle program that's going to run into the 2070s.
A century-long revenue stream. It's almost immune to cancellation.
The scale is just staggering.
Yeah.
And here's the real power of LMT.
Yeah.
Even when the Pentagon gets frustrated, and they are always publicly frustrated about cost overruns or sustainment.
Always.
They can't rationally switch. They are completely locked in. Why? Because no other platform exists that integrates with allied command networks, with the logistics, with the shared intelligence.
They literally own the ecosystem. And the brutal reality is, starting a new fifth-gen fighter program from scratch would take 15 to 20 years just to get to initial capability.
Right. You'd be leaving this massive, unacceptable gap in Western air superiority. So LMT doesn't just sell jets. They own and sustain the entire tactical air superiority infrastructure of the Western world.
And that moat isn't just stable. We'd argue it's actually widening.
Why widening?
It's the network effect. The interoperability with allies. Think of it like a defense-focused social network. As more NATO partners, and you're seeing huge orders from Germany, Poland, Japan, buy the F-35.
The value of the network increases for everyone.
Exactly. The shared data network becomes exponentially more valuable. Every new jet sold locks all the previous customers in even tighter. It makes it even more inconceivable for the U.S. to ever abandon the platform.
We use mental models to simplify this stuff, and the F-35 is a perfect example of the surgeon's model.
Right. If your life depends on a brain surgeon, you don't pick a new one based on a small price difference.
Because failure is terminal.
Yeah.
And mission-critical tech, whether it's a jet or a missile, is the same. The customer tolerates the high cost because operational failure is simply not an option.
You also see what Charlie Munger called the Lollapalooza effect here, this compounding of multiple advantages all working together. LMT has a top-secret clearance needs, the massive capital intensity that just excludes everyone else, and the political reality of creating jobs in dozens of states. That political layer is another firewall. It makes the company almost unkillable.
So let's add some color to that. Let's look at the customer and employee perspective, the scuttlebutt. The relationship with the U.S. government is best described as tolerated necessity.
Tolerated necessity. That's perfect because you constantly see Congress or the Pentagon publicly criticizing LMT. They complain about sustainment costs, delays.
It's political theater. They have to show they're concerned about taxpayer money.
But, and this is the key, at the exact same time they're complaining, they're increasing the order volumes. Every single year. The criticism is noise. The orders are the reality. They complain about the price because they must, but they sign the contract because they have to.
Yeah. And internally, From the employee side, the sentiment is a bit mixed. You hear about the bureaucracy, how slow it can be,
Hmm.
which is typical for any company so closely tied to government regulation.
Sure.
But that's balanced by this deep, almost unparalleled pride in the mission. They know the impact of what they're building.
And that creates a sticky workforce, which is another structural advantage. These are engineers with top secret clearances. That clearance is an incredibly scarce and expensive resource, while LMT effectively hoards this talent.
Making it very hard for anyone else to compete on high-level classified projects. So let's pivot to the competitive landscape for a second. LMT's rivals are huge. RTX, Northrop Grumman, Boeing Defense. But they're really playing a different game.
And this is a point that cannot be overstated. LMT is the platform integrator.
Yes.
They own the prime contract. They own the jet, the satellite, the whole system. And that means they own the longest, highest margin part of the revenue. The maintenance, the upgrades, the software modernization.
Exactly. RTX might make the radar, Northrop might do the engine or focus on a specialized bomber like the B-21, but LMT is the general contractor. They own the whole ecosystem, which ensures these persistent, long-duration revenue streams that their competitors can only get a piece of.
So the structural advantages we're seeing in Pillar 1 are just profound. It's a regulatory, technological, and political moat all wrapped into one.
Which brings us very naturally to Pillar 2, management, stewardship, and strategic vision. Because a fortress is only as good as the people running it. So we need to look at CEO Jim Tacklett's vision and their capital allocation discipline.
Tacklett's an interesting guy, former pilot, but he came up through telecom, leading American Tower, so he's not a traditional defense guy.
And that's crucial, because it informs his whole strategy, what he calls 21st century security.
This strategy is a really important pivot for the company. It's a deliberate move away from just bending metal, the traditional manufacturing, to becoming a tech prime.
So integrating 5G, sophisticated software, data analysis, AI, all of that directly into the existing platforms.
Right. Now, this sounds great in a press release, but I want to push back a little. Moving from a world-class industrial firm to a world-class software firm, that is a massive cultural shift.
A huge one.
Can a 100-year-old defense contractor, known for being slow, really out-innovate a nimble startup like Anduril? Or is this just, glossy PR for the market?
That's the billion-dollar question for a long-term investor. The strategy itself, though, is rational. They're trying to future-proof the business.
They have to.
They're trying to stop the hardware, the jet, the ship, from eventually being commoditized. If LMT can own the digital backbone of future warfare, they essentially build a new digital layer on top of their physical moat.
It's a necessary adaptation, even if the execution risk is really, really high.
It is high. But let's look at their incentives, which tells you where management's real focus is. We look at their long-term incentive plan, their LTIP, and honestly, it's what we'd call the gold standard in the industrial space.
It avoids that common trap of just focusing on revenue growth. Their compensation is tied directly to three key things: return on invested capital, or ROIC,
Which is paramount for us.
performance cash generation, and total shareholder return.
That focus on ROIC is everything. It incentivizes capital efficiency. It forces management to focus on returns for the owners, the shareholders, not just empire building for the sake of getting bigger. If you want to get paid, you have to be efficient with your capital.
And that brings us to capital allocation, where LMT really shines. They are what Charlie Munger would call a cannibal,
A great term.
a company that consistently and aggressively buys back its own stock. They are laser-focused on returning cash to owners.
And you see that in two clear ways. The dividend, first. LMT has raised its dividend for over 20 consecutive years. They're getting really close to dividend aristocrat status.
Which is 25 years. And when they hit that, it's a potential catalyst. It brings in a whole new class of passive capital.
For sure. And on the buyback side, the policy is meaningful. They consistently retire between 1% and 2% of the shares outstanding every single year.
That's material compounding. It just mechanically increases your stake in the business every year without you doing anything. It's quiet wealth creation.
But we always apply the rationality test to buybacks. Are they just buying back stock because they have cash, or are they buying it back when it's genuinely undervalued?
And LMT passes that test. You just have to look at 2021 and 2022. The stock price was kind of languishing. There was uncertainty about the budget. And what did management do? They accelerated the buybacks during that period of cheapness.
And that proved two things. One, they view the share count as a finite resource. And two, they're prioritizing the long-term owners by capturing value when the stock is down. That's the definition of shareholder-friendly discipline.
Okay, so the mode is solid, management is disciplined. Now we have to move to pillar 3, the financial fortress. We need to confirm that the numbers, the profitability, actually support everything we've talked about.
And the first thing that just jumps off the page is the consistency of their margins. Lockheed's operating margins are famously, almost boringly, consistent.
Hmm.
They sit in that 10 to 12% range quarter after quarter.
Now, that consistency is a huge sign of strength. It's predictable. But we have to be realistic that 10 to 12% range is a structural cap.
It is.
The DoD, as the single buyer, is just not going to tolerate 30 or 40% margins like you'd see in a software company.
But here's the trade-off. That cap is what provides the stability. Because the margin is capped, the DoD isn't desperately seeking competition to crush them. The stability is protected by the total lack of viable alternatives.
It's a stable margin in exchange for an untouchable market position. So let's drill into the key quality ratios, starting with the big one, return on invested capital, ROIC.
LMT has a consistently high ROIC, typically in the phenomenal 15 to 20% range.
And for anyone familiar with industrial companies, that number should make your jaw drop. I mean, this is a capital-intensive business with huge factories and production lines. So how do they do it? How is that number so high?
The secret is in the capital structure and the nature of their customer. LMT gets that high return because the U.S. government often funds the really heavy lifting of R&D.
Right. It's called Customer-Funded Research and Development, or CR.
CFARD is their massive, hidden competitive advantage. When the government funds the R&D, LMT is basically developing billion-dollar technologies without that investment ever hitting their own balance sheet.
So the denominator in the ROIC calculation invested capital is artificially low relative to the massive profits they generate.
And the ratio skyrockets. It's effectively a quiet government subsidy for innovation. LMT gets to develop next-gen tech without putting shareholder capital at risk. That's pure financial quality.
The second ratio is free cash flow conversion. This is the ultimate test of how real the earnings are. LMT consistently converts over 100% of its net income into real distributable free cash flow.
And for you, the investor, what that means is simple. These are high-quality, truthful earnings. The profits aren't just accounting tricks or non-cash items. When LMT says they made money, that cash is actually in the bank, ready to be used for dividends or buybacks.
Finally, the balance sheet. They manage their leverage very prudently. Net debt to EBITDA is usually around 1.5 times. They're not taking on huge financial risks.
And you have to look at the unique nature of their debt. While they issue corporate bonds, the market sees that debt differently because their revenue is so tied to the U.S. government.
The ultimate risk-free entity.
That debt is essentially viewed as being backed by the full faith and credit of the U.S. Treasury.
Which means they can borrow cheaply, maintain high credit ratings, and it gives them the confidence to keep up the dividends and buybacks through any economic cycle. That financial stability is the absolute bedrock of this whole thing.
Okay, so we've established LMT is a phenomenal business, structurally protected, well-managed, financially sound. But we're investors, and a wonderful company can be a terrible investment if you overpay.
This is the critical part, pillar 4, valuation, risks, and the price you pay.
Historically, LMT has almost always traded at a discount to the S&P 500, usually in that 15 to 18 times PE range, despite its superior stability.
So why the discount? There are two main reasons. First, the growth is capped. Defense budgets, in real terms, they basically track GDP. You're not going to get 15% revenue growth here.
Right. And second, and this is increasingly a factor, are ESG concerns: environmental, social, and governance.
A genuine headwind. A lot of institutional funds, especially in Europe, have rules that just prohibit them from investing in defense companies.
So that permanently restricts the pool of potential buyers, which kind of acts as an anchor on the valuation.
But we have to acknowledge that historic discount is being challenged right now. LMT is trading near the upper end of its historical range.
Driven by what we're calling global conflict anxiety. When the world looks dangerous, this stock looks like a safe haven, and money just flows in, pushing the multiple up towards 20.
So how do we define a margin of safety for a stock that fundamentally refuses to crash? Since it's a slow compounder, the safety isn't in the PE. It's defined by yield.
Exactly. We look for an entry point when the combined yield, that's your dividend yield plus the buyback yield, is significantly higher than the 10-year Treasury yield, ideally by 3 or 4%.
That cash yield cushion gives you a superior defensive return compared to the risk-free rate. That's the whole point of a high-quality defensive asset.
Which brings us to the final hurdle, price. Even for a business this wonderful, Paying more than 20 times earnings for a company that is structurally capped at 4% growth is just,
Yeah.
it's mathematically poor investing.
Your returns would have to come from the multiple expanding even more, which, given the growth cap and the ESG headwinds, just seems unlikely to be sustained. Your entry price dictates almost all of your returns over the next decade in a business like this.
So let's pivot to the growth engines and the real risks. The primary growth engine for LMT isn't actually the U.S. budget anymore. It's international exports.
This shift is undeniable. The peace dividend era of the 90s and 2000s is definitively over. U.S. allies, globally, Germany, Japan, even historically neutral countries, are aggressively rearming.
And LMT is the primary beneficiary of this, especially with NATO's commitment to spend 2% of GDP on defense. Poland is dramatically expanding its fleet. Germany authorized a €100 billion special fund for its military.
And a huge chunk of that is going to U.S. platforms. LMT already has the approved platforms, and now the world is lining up to buy them.
But we have to confront the two big, non-obvious risks. The first is fixed-price inflation risk.
This is a critical point. In a high-inflation world, those long-term fixed-price contracts, they become toxic. LMT's costs for labor, for raw materials, they're rising fast.
But their revenue is frozen at a price they agreed to years ago. That gap is where profit dies. And we saw this happen recently. LMT had to take about a $2 billion charge on a classified program.
Why?
Because the sudden spike in inflation just completely blew past their original cost projections.
And that $2 billion hit is a direct signal of a trend. The government is shifting risk onto the contractors. They now have to bear the burden of macro uncertainty.
The second, and maybe more existential long-term risk, is the U.S. fiscal crisis. Just look at the numbers. Interest payments on U.S. sovereign debt are starting to crowd out everything else in the budget.
And the defense budget is the single largest pot of discretionary spending. It's the most vulnerable target if the fiscal situation gets worse.
If interest expense keeps growing, the defense budget faces a serious, politically inevitable cut, no matter what the geopolitical threats are.
This isn't theoretical. We've seen it before during budget sequestration. Defense spending is often the sacrificial lamb in domestic politics.
So now let's look at some potential catalysts, the silver linings. A huge one would be winning the contract for the Next Generation Air Dominance, or NGAD, the successor to the F-35.
Or cementing leadership in hypersonic missiles. Either of those would unlock a new, massive 20-year revenue stream.
The second, quieter catalyst goes back to that dividend aristocrat status. Hitting 25 years of dividend increases will automatically attract a whole new class of passive ETF capital that has to own the stock.
Finally, let's apply some second-level thinking. The consensus view is simple. War is good for LMT. We need to challenge that.
We fundamentally disagree with that. Our view is that a Cold War is actually far better for LMT's profitability than a hot war.
How so?
Active shooting wars primarily consume low-margin munitions. LMT makes them, but that's not where the big profits are.
A sustained, high-level tension, a Cold War posture, is what drives the political will to fund and buy the high-margin, complex platforms. The jets, the satellites, the strategic deterrence systems.
So investors should prefer tension over actual conflict. It's the complex platforms, not the munitions, that drive long-term shareholder value.
This has been a true deep dive. Let's synthesize this all into the final investment memo summary, starting with the bull case, the reasons you'd confidently own this fortress.
The bull case rests on three things. First, durability. It's an effective monopoly on Western air superiority, with revenue backed by the U.S. government.
Second, capital return. It acts like a bond proxy with low volatility and inflation protection. It's an aggressive cannibal with a healthy combined yield, making it a great defensive compounder.
And third, geopolitical tailwinds. The global rearming trend ensures a long growth runway for their high-margin platforms like the F-35. The peace dividend is over.
Now the all-important counter-thesis, the bear case. What could really damage returns over the next decade?
The main financial risk is margin compression. The government is pushing risk onto them with fixed-price contracts, exposing them to inflation, just like that $2 billion charge showed us.
Next, the valuation trap. Trading your 19 times earnings with low single-digit growth just doesn't leave much room for error. It caps your potential upside.
And finally, tech disruption. While LMT is pivoting, agile competitors like Anduril and SpaceX are building faster and cheaper. It's a long-term threat to their dominance and autonomy in space if their pivot doesn't work.
We always end with the red team challenge, the inversion, to force you, the learner, to think about the downside risk in a different way.
Here's the provocative thought to mull over. The greatest, most immediate threat to Lockheed Martin's stock returns is not China or Russia. It's the U.S. Treasury yield curve and a domestic fiscal cliff scenario.
Explain that. In that worst-case scenario, where U.S. debt service crowds out everything else, defense spending becomes the political sacrifice. LMT wouldn't go bankrupt,
The doors would stay open?
but it would suffer a lost decade of flat revenues and painful multiple compression as the market just re-rates the entire sector lower.
That scenario turns what looks like the safest stock in the world into a definitive wealth trap. You'd get zero capital gains, only a bond-like dividend. It would fail to meet the return hurdles for long-term equity investing.
It's the ultimate paradox, isn't it? The stock stability is backed by the U.S. government, but the financial instability of that same government poses the greatest systemic risk to your returns.
It forces you, as an investor, to always weigh that fundamental business quality against the price you pay and the huge macro risks that even the best companies can't escape.
Absolutely. Thank you for joining us for this extensive deep dive into the Lockheed Martin fortress.
Keep researching, stay disciplined, and we'll see you next time for the next deep dive.